lots of moves up and down on the index. Jigar Mistry is with us, co-founder Buoyant Capital. Jigar, good afternoon. Good to have you with us here. You know, Nigel and I were earlier talking about how metals and cement was your area back in the analyst days, Jigar. So, Don, the analyst, had for a bit. We just had this discussion with JSW. Any thoughts on the situation now that JSW finds itself and implications?
Hi, Prashant. Thank you as always for inviting me to the show. I think it's quite a stock-specific situation, right? So it's not so much as an industry-related question as much as it relates to JSW. And I think all the legal luminaries that you called on the show essentially point to the fact that there has to be some sort of a petition given how much money has already gone into this. And eventually, if it's a case of business rather than just a letter of the law, then I think they might be keen to look at it. In between, when by the time this happens, you will have some sort of situation. And remember, see, with metals or cement, it's always the marginal quantity, right? It's never the total demand supply. And in the situation that some amount of steel is taken off the block, you will see a situation which will make it an even starker business call rather than sort of the letter of the law. So my sense is that you would see some sort of a resolution come through. What shape and forms it takes in the courts is a little difficult to predict given how long this review has taken the time to come. But steel per se is nevertheless interesting. So the last time I was on the show, we did sort of discuss about commodities. And those businesses make a lot of sense because, if the dollar is depreciating, everything is denominated in dollars. And steel is one cycle where you don't really see a lot of China flooding on an incremental basis. So if this gets resolved, then obviously steel does make for an interesting play.
Hi, good morning, good afternoon, and thank you very much for joining in. Lots of earnings reactions visible on the screen. You've got Indus Stars down nearly 7%. Eternal is holding up despite the big losses in quick commerce. Perhaps the street likes that they are being aggressive to protect their turf. You've got Nugent Software up 3.5%, come off from the highs, but that's up after the recent correction. In the earnings that we've seen today and over the last 48 hours, which one has been the pick of the lot?
Right, Reema. So, sort of see, as an overall general sense, I would say that earnings should start improving over the quarters, right? So, the way we used to do this even during COVID, we used to see like not a FY20 drop and a 21 pullback, but the way we used to see, FY19 over 21, I think a very similar situation will go in the earnings per se. So you will have the April to June quarter last year take a beating because of general elections. And since then, you have seen successive quarters really going down. That base effect will now start coming into play. So stock specific, obviously, Indus was not really a great set of numbers. Zomato is not so much, or Eternal is not really so much question about the cash flow versus sort of the plan that they plan to execute. And given where competition is, on one hand, you have sort of Reliance come through and challenge things. On the other hand, you're having questionable Zepto financials and people weighing that in the process. But my sense is that overall earnings should start improving just basis, the base effect and other than anything else. And given the correction, at least we have seen in a large part of the broader market, few businesses which are even okay-ish result will not really see a large downside.
Okay. That's the sense. Jigar, hi, good to have you on. So, what are you liking in the market right now? Where do you see some earnings momentum? I mean, the tariff news aside, I think the other watch point is earnings. And where do you see that?
Right, Surabhi. So I think, you will see this play out in one sector that we are very keen on, and I'm sure Nigel will want to chip in here, because cement looks like a sector where, you've seen, I remember this time, 2004 to 2008, riding on a very high capacity utilization, the sector's EBITDA per ton overall moved up almost 2x. Since then, since 2008, there have been a lot of capacities that came through. And because of which, and sluggish demand, you saw EBITDA per ton across the industry quite flatline. Now, what might actually end up happening is that the industry has gotten consolidated. Two large players have consolidated it. And there might come a time where sort of they start taking price increases seriously in a way where you cover up for inflation and more in the EBITDA per ton. The way to play this thus far has been buying all the acquiree companies, right? So you've seen multiple sort of deal-related upsides on them. But the way to play them going forward could very well be the larger names because that's where the impact will be quite meaningful. Like, Ultratech saving sort of 300-400 rupees on costs is thousands of crores in EBITDA incrementally, right? So that is essentially the way what we like in the current scheme of things.
Okay, all right, fair enough. VMart, by the way, numbers at the bottom of the screen, and look at the earnings, 18.5 odd crores compared to a loss of about 39 odd crores. This is what is coming through. Stock spiking as we speak. I think last quarter as well, the numbers were pretty solid, pretty strong after a few years of absolutely lackluster growth that VMart has seen as a tier 2, tier 3. Actually more a tier 3 city sort of operator, retail stores. But now, of course, it is jumping. So 17% growth on top line and, of course, at the bottom line, it's swung into a profit as compared to a loss same time last year. Jigar, just come in on anything you like in the auto ancillary space. Many stocks here have taken a knock. And, the thing with auto ancillaries is not just sort of serving auto markets. So many of these auto ancillary firms now cite non-auto industries as big growth areas. We spoke to one in the morning, Sona BLW. What do you like, Jigar, here?
Not a lot of things, Prashant, here, because see, incrementally you are accounting for the fact that many of them were supplying to either railways, or some parts of it, reasonable parts of it in some cases, were exports. Till the time this sort of export scenario with the tariff tantrums doesn't get resolved, one needs to look at where the earnings growth could come through. Secondly, even with regards to railways and related capex, I think the way in which things are shaping up both at the central and the state government level, like we analyzed the state budgets of 16 states, and these are the ones where the freebie bill, for the lack of a better word, is now approaching the capex spends, which means the capex for many of these are going down almost 4-5% on a YOY basis. In that, and with sort of central government also taking a foot off the pedal, the complex of earnings could change away from this railway, defense, PSU to a lot more in consumption, and that's why you are seeing some of these results also play out fairly well, where this incremental money that's put in the hands needs sort of a way where either it gets invested or spent. And we think a better way to play this, given the extremely high valuations in many of these cases, would be the consumption plays rather than capex plays.
Okay. All right. Jigar, we'll leave it on that note. Thank you very much for joining us. Good to have you on the show.